Hello, everyone. This is Tom Fox, and I would like to welcome you to episode 87 of the FCPA Compliance and Ethics Report. In this episode, which is part two of my series on internal controls, a conversation with Henry Mixon, we continue our conversation on what are internal controls and sort of some of the basics for the compliance officer. In this part, Henry takes a look at what a company needs to do to put internal controls in place, and wraps up some of his thoughts on points to remember about internal controls. I hope you enjoy it. Thank you.
FCPA Compliance and Ethics Report. This is really a continuation of a visit I'm having with Henry Mixon of Mixon Consulting. We are starting a series on internal controls. We started on our last episode, and we ended up having to split this into two parts. And so we're going to pick up where we were. Part one, for those of you who didn't have a chance to listen to part one, Henry is a former audit partner at E&Y. He's worked in the corporate world in internal audit. He has implemented an internal controls program for major corporations. He has worked as a fraud investigator, is in private practice now. He and I have worked together on several large FCPA projects. So welcome back, Henry. I'm glad you could come back for part two of our visit on kind of the big picture on internal controls.
Well, thank you, Tom. It's a pleasure to be here.
Henry, we ended up on part one. We were talking about the COSO framework, and you were able to explain to us what that is and how a company and certainly a compliance officer might use that. But I'd like to now move to something that kind of left open, which is, suppose an organization uses the COSO framework for internal controls because it is an accepted standard that is certainly recognized. What should a compliance officer do with that information?
Well, I think the primary thing is to keep in mind that even if an organization adopts that framework, there will be very few people within that organization who will have the unique knowledge that a compliance officer has that would impact all of the elements of that framework. And so I think the compliance officer's role is to provide the input to the CFO and others involved in implementing the framework to be sure that there's a proper focus on the risks that really are part of the compliance world. And I think that primarily the input comes in the risk assessment component, the control activities, and then the monitoring. And so addressing those basically in turn, I think in the risk assessment component, companies typically do risk assessment from an operational standpoint, and they address business risk going forward, and they develop the controls that deal with those business risks, which could be, project financial results or doing business in certain countries, strategic decisions, that sort of thing. So I think a compliance officer has the unique perspective to offer in that risk assessment to say, if you look at our risk assessment from the bottom up at the transaction level, we have some very significant compliance risks that need to be added to the mix. Because before we start allocating our resources, we need to get these compliance risks in the list so they can be considered. And these are risks that typically lead to controls that are not addressed by most companies. For example, the risk that a vendor who has not been properly vetted could get into the vendor master file and be paid. I've worked with companies where all it takes to get a vendor in the master file is to make a phone call to accounts payable. I've worked with companies where all it takes to get a vendor in is to submit an approved invoice with the vendor's name on it. So that's a risk not typically addressed. Similarly, the risk that the delegation of authority may be developed without specifically dealing with country-level and transactional risk that are significant to the company. So there are a number of perspectives, including those dealing with third parties, quite a few others, where the compliance officer should speak up and say, we need to consider these risks.
Well, Henry, let me focus on one specific one because it's something that I, as a general counsel and a compliance officer, really didn't understand how it would impact or affect my compliance program. Yet it is almost a basic financial control, and that's delegation of authority. How does that work in a compliance program, or rather, I suppose, more appropriately address a compliance risk at country level approvals or approvals for other types of transactions?
Well, I think the idea here would be that many companies define in their delegation of authority approvals for certain kinds of transactions based upon dollar amounts. And I think companies should consider that there may be other considerations other than dollar amounts which perhaps should elevate a given transaction to a higher level of approval. For example, a wire transfer to move money between bank accounts in the United States for $200,000 might require a certain level of approval. But a wire transfer for $200,000 to move money into Ghana might require a higher level of approval in the delegation of authority. And so it's really a matter of, within the delegation of authority, what kinds of things or what geographical locations need to be pushed up to higher levels to get more scrutiny.
Let me turn to another area that I've heard you speak about and certainly educate me on over the years, and that is monitoring. Most compliance professionals understand the internal audit and audit role in a compliance program, but they think that auditing means monitoring, where they're actually very different. They certainly could interrelate and they certainly could overlap, but maybe could you explain monitoring and how that internal controls work with monitoring, and maybe what the two elements of monitoring are as you see them?
Sure. Monitoring probably is one of the more confusing elements, because in my meetings with compliance officers, when we start a discussion about monitoring, I know what's coming. They're going to say, well, we have an internal audit department and we have an independent audit and they monitor. And that's the end of the story. And I think those, if I press just a little bit, I typically find that those are presumptive conclusions. They're not based upon the compliance officer having had any kind of discussion with the internal auditor or having read the audit plan. It's just an assumption that internal audit will deal with all the right issues, and one of those being compliance. And what I find more often than not is that internal audit does not focus on compliance. They don't have FCPA experience as a rule. That's one issue. The other issue is they typically deal only with detect controls and the paper results of historical transactions. And then the other thing is they have a number of constituencies to serve as well. They have to satisfy the chairman of the audit committee, and they have to define an audit universe that meets a lot of different needs, and they, like every other part of the company, have limited resources. So I hear a lot of a default conclusion about internal audit, being the monitoring, but as you notice when you read some of these enforcement actions, for example, Eli Lilly, they say, well, internal audit department had no procedures to assess FCPA or bribery risk. The auditors relied upon the standard accounting controls, which assured the soundness of the paperwork. And that's not being critical, it's just being factual. It's what the internal audit world is all about. So you really need to step back and say, yeah, you can use internal audit to do monitoring, but it needs to have the input of the compliance officer to make sure it deals with the right issues and the right countries and the right risk. And the second part of monitoring is really the compliance officer should step back from the day-to-day grind and develop some metrics that can show the chairman of the audit committee and others how the program is working. These are not metrics like, we established 25 new internal controls this month. These are metrics like reduction in number of potential violations identified, reduction in reports to the hotline, percentage of employees who completed training. Whatever measures the compliance officer thinks are important need to be part of the monitoring. It's kind of like a scorecard, but it would be unique to each company based upon what the compliance officer perceives.
Henry, one of the things that you've touched on kind of throughout part one and into part two here of our initial discussion of the internal controls is why should a compliance officer be concerned about internal controls? But maybe could you give a little more detailed thoughts if an organization has an accounting department, internal audit, or independent auditors? Really, why should a compliance officer or chief compliance officer need to be concerned about internal controls?
Well, I think the number one reason that a compliance officer needs to be concerned is if you read the last few enforcement actions by the SEC and the Department of Justice, it's clear that those agencies are focused like a dog with a bone on the concept of internal controls not being effective. And the real issue there is, okay, if our company's internal controls regarding compliance are not effective and the compliance officer does not step in and try to make them effective, who else is going to do it? And the simple answer is no one else has the experience or the knowledge to do it. So that's the very simple answer why it's important. Now, it may be unfamiliar territory, but it is very important that compliance officers get involved with internal audit and get involved with the chief financial officers and make sure that their expertise is used by the company to have a system of internal controls. I wouldn't propose that compliance officers be challenged with the actual process of designing those controls, but I think their input is the only input in a given company that will put issues on the table that can prevent future violations.
With you mentioned several enforcement actions, and I think we've already talked about Lilly, HP, perhaps Smith & Wesson, and others. But more than simply the enforcement actions, which tell us what the government is looking at, could you maybe explain the difference in the services that internal auditors would provide and some of the types of preventative techniques that internal controls can bring if they're brought in by a chief compliance officer?
Yeah, typically, the internal auditors, the head of internal audit of the company prepares an audit plan each year, and in that plan they allocate resources to certain kinds of audits. Some of them are very traditional audits, like auditing of the accounts payable department or the payroll function or whatever. Most of those audits are pretty much focused on the paper that supports the transactions. So internal audit can really be used very effectively if they get guidance on how to have audits in their audit universe that deal with the preventive controls that are important to compliance. For example, they could have an audit of changes to the vendor master file each year to see if the preventive controls that are in effect to keep unvetted vendors out of the master file are working, to see if the controls to keep someone from adding a vendor and paying an inappropriate invoice, then deleting the vendor, to see if those controls are working. So they can add that audit. It's just got to be within the grand scheme of their resources. They have to take something else away to add that one. So in effect, the compliance officer is going to have to be somewhat of a salesperson to convince management of the importance of including the compliance risk preventive controls into the universe for internal audit.
Henry, my wife is a process analyst, and she has kind of drummed into my head that to validate any process, you have to have a second set of eyes on it. And that seems to be one of the themes that I'm hearing from you throughout this, is really internal audit can be viewed as a second set of eyes.
That's basically,
is that correct?
That's correct. That's basically it. I mean, one of the fundamental premises is, it's very hard to audit and to validate your own work, because it's pretty hard to see where you didn't do it right sometimes. So the second set of eyes, even though internal audit, by definition is not really independent in the same context as an independent auditor, any second set of eyes that can second guess the thought process and the conclusions is a valuable input. And whether that be somebody outside the company or somebody inside the company, I think there needs to be validation. The whole concept of monitoring is, it's awfully hard to totally internally monitor your own processes because of the dynamics of internal activities, just the way they work in corporate America. But it can be done.
Henry, let me change the subject just a little bit, because I think certainly as a lawyer I appreciate this, and as a compliance officer I've heard it a number of times, which is the legal department, the compliance department, perhaps the audit department are known as the land of no,
right,
where Dr. No resides, and they're really there to slow business down, in fact, to be antithetical to what the business development guys are out there really trying to do. How do you respond to the sort of general criticism that controls just slow things down and add costs that are corporate overhead costs that are really not mandated? How do you deal with that type of argument?
Well, that is far and away the most difficult part of the whole process, because having been an officer of a public company and a member of the management committee, I know, how difficult it is to add things, particularly administrative things that don't generate revenues. But I think at the end of the day, a well-reasoned presentation of, if we add this, here is the benefit we get, or if we add this, here is the significant potential downside we avoid, then there can be a balancing of adding things. I think too often, maybe compliance departments and internal audit departments just say, no, that can't be done, without really explaining, why it can't be done, or without they maybe surface an idea without really fully explaining the benefits of doing it. That's the only way I was able to achieve my objectives when it comes to adding controls was to say, well, here is the risk that's going to be totally unmitigated if we don't add this control. Is management willing to run that risk? And put it in a perspective of, if you have to as a compliance officer, well, we can run the risk of not having good control over the vendor master file if you want to incur the cost and the penalties and the time-consuming distraction from operations that these other companies incurred because they didn't have the controls. Because that's really the bigger picture. Yeah, you can easily dismiss a proposed control, but the perspective is, well, you may never have the problem, but if you do, it's going to cost you big time. So what is your appetite for that risk?
What would you say is the single most important reason why compliance practitioners, compliance officers, chief compliance officers should be not only concerned with, but really involved with internal control?
Well, I think that the single most important reason is a very practical one, and that is the DOJ is getting a lot smarter about what the concept of effective internal controls really means. They're getting a lot smarter about saying, because this happened, you didn't have effective controls and you therefore violated the FCPA. And so as the DOJ gets smarter, I think compliance officers have to address the issue, as difficult as it may be, because that's simply becoming the focus in the compliance arena. And that SEC administrative proceeding against Smith & Wesson, where they basically said, well, you may not have been successful with your bribes, but you still didn't have good internal controls, even though you had policies. I think it just points out that a compliance officer is in a unique position with unique knowledge in a company to avoid those financial penalties, and that's basically the role. The role is defined lots of different ways, but in my view, if the enforcement arena is focusing on internal controls in the FCPA world, then if I were a compliance officer, I would figure out a way to make that my focus.
Henry, we're near the end of our time on our, which turned into a two-part episode on internal controls. In summary, could you maybe give 3-5 points that the compliance practitioner might be able to walk away from this two-part episode from on internal controls?
Well, I think the first primary point to keep in mind is having policies without having effective risk-based controls will not prevent bribery. That's proven by the enforcement actions. I've had CFOs tell me, I don't understand, we keep issuing policies and people still keep doing the wrong thing. Well, you got to have the underlying controls for it to work. I think another thing to keep in mind from this whole thing is the rogue employee defense of saying we had policies, we had procedures, we had training, these guys were rogues, will only work if there were really some controls in place that the rogues circumvented. So the issue of a rogue employee, I think in today's world, is only relevant if you're saying, well, these guys circumvented our controls. It won't really work if you didn't have the controls. Another thing to keep in mind is there may be a belief that, when I propose effective controls, I'm saying they have to be the same company-wide. They really don't. But the control objectives that are being met have to be the same company-wide. As you remember from the company you worked for that was my client, that was a roll-up of many different companies with many different accounting systems and ways of doing business. Each of those entities developed effective controls, achieving a common control objective. And then the other thing, which I've heard you refer to many, many times, is you have to document the evidence of the controls if you want to prove to a regulator you have controls. You can't just say we have a procedure. If the procedure is not evidenced, you can't prove you have the control. And then to repeat, having policies without effective risk-based controls will not prevent bribery. And I guess, the final message in the summary would be, if the DOJ and the SEC make it clear that companies are expected to have effective internal controls, you don't want to be like the cartoon character Pogo and say, we have met the enemy and he is us.
Well, I really appreciate your reference to Pogo. I would have to say you probably dated yourself a little bit.
Probably.
I think he's even in the Sunday Chronicle anymore, but I can certainly remember my father talking about that cartoon and reading that one myself over the years. I don't think I really set out what Henry and I wanted to accomplish and do going forward, but our next podcast, we're going to take a look at some specific internal controls for some of the areas that are of concern under the FCPA. So we're going to have one on third parties. We're going to take a look at internal controls for gifts, travel, entertainment, and charitable donations. We're going to have an episode where we look at internal controls for training, discipline, incentives, compliance, communications, and perhaps mergers and acquisitions. We're going to take a look at some of the reported FCPA enforcement actions, both through the DOJ and SEC, where there was a failure of internal controls. The more I listen to us talk, Henry, and think about it, that may turn into a two-part episode. And then we'll probably need to have a wrap-up episode to sort of summarize where we've been and some of the things we've learned. And perhaps we can have some of our listeners comment. If anyone has any questions they would like answered or they would like us to explore, you can email me at tfox@tfoxlaw.com. And Henry, could you tell the folks again, if they wanted to get in touch with you directly, how they might do so?
Yes, my email address is hmixon, that's Mixon, at mixon-consulting.com.
Well, Henry, I'd really like to thank you for visiting with me again for part 2, and I look forward to visiting with you next week, where we take a look at internal controls for dealing with third parties.
My pleasure. Look forward to it.
All right. Thank you very much. We are off the air.